predicting the markets is very, very difficult. What makes a difference? So how do we make money? So the simple question of out of all this gyan which we're trying to share with each other, I'm sure some of you would have felt like asking me, is that finally, what should we do, and how can we make a difference, or is it that there's nothing can be done? The fact is, there are two, three simple rules when it comes to investments. And most of the times, what we have noticed, and holistic investments, Ramlingam sir and team can also share with you a lot of their experiences, uh, is that we have seen behavior can be our worst enemy. And there is nothing to be feeling guilty about it, because all of us go through this. So, as I said, being a financial professional doesn't mean that I would be very good with on my personal finances. That's not the case. That mostly is not the case for most of us. So, uh, typically, what happens is our emotions get swayed significantly by what is happening, what events is happening in terms of economies, in terms of markets, the developments which is happening worldwide, what we keep hearing through a lot of this social media. All of this plays a very, very big part in what kind of decisions we take. And a lot of times it can be fairly irrational. That is how human behavior works. So, so some of these quotes from Benjamin Graham, very, very admired investors of all times, tells you this very simple fact that we set a lot of rules. Your advisors would be telling us, or our advisors would be telling us that you need to do this, don't get panicky, or don't get too much optimistic or overboard on some particular asset class. But all this gets forgotten. See, today, for instance, a lot of investors want to participate in equity markets, and a lot of them wants to participate in IPOs only, because what we're seeing is huge listing gains. But for every 10 successful IPOs, there are 15, 20 IPOs which are nondescript, where you actually end up losing money over a period of time. So that happens, but nobody will talk about that. They will only talk about success stories, which will easily suck a lot of investors in, and then lead to all this kind of challenges. Another behavior which we keep seeing, a little unfortunate, but this happened even in 2020, wherein we initially thought this time it is going to be a more mature kind of investor behavior. All of you have heard about systematic investment plans, which is one way where you don't get too much swayed by the emotions. You just put investments in you or keep investing in a disciplined manner across market scenarios. But unfortunately, for us at an asset management company level, and also for the entire mutual fund industry, what we witnessed that between March of 20 till about December of 20, we had seen significant, or maybe November of 20, we would have seen a significant amount of stoppages of systematic investment plans. A lot of people, and it was not completely unreasonable, to be honest with you. Most of the investors actually got into equities and equity related investments through SIPs somewhere in 2017, when the markets were reviving in a very, very big way. There was a lot of optimism at that point of time, which kind of petered off in 2018, 2019, 2020. It actually struggled, the market struggled. And naturally, for three years, people were seeing their SIP returns turning negative and a lot of worries. And moment the market started moving up a little bit, they said, it's the time, let me get out. At least we're getting close to par. Let us get out. And then we know what they have missed. So another 9 months would have made a huge difference, or we don't know, even probably another few years could make a huge difference to their overall wealth creation possibilities, but that was lost. And as I said, it's slightly unfortunate because it keeps repeating cycle after cycle. So this leads to a particular situation which is very, very well accepted in terms of financial concepts. It's called behavior gap. It's behavior gap which leads to return from a particular product, particular scheme, particular stock being suboptimal for a lot of investors. Whereas that particular individual fund or whatever instrument it might be would have delivered excellent returns, but most of us would not have experienced that. So we have one of our oldest funds, just to example, I'm not trying to promote any fund here, but we have one of these oldest funds called Nippon India Growth Fund, which has got a 25-year track record now. That particular fund had seen 10 rupees scaling to 1900 plus over this period of time. which is a compounded growth of almost 20 to 23% over this period of time, which is fantastic. We would not have seen that kind of returns across most instruments. But the fact is, there would be very, very handful of investors today who would have actually stayed through this kind of period. Most of us would have got swayed by the market conditions, as I said. Uh, Typically, when things did not work, say between 2009 to 2013, when the markets went through a very low phase of growth, a lot of us would have redeemed, moved out, possibly got back in 2014 times when again the rally was visible, again got frustrated in 15, 16, 17, possibly some of us would have come back, again got frustrated in 18, 19, 20, and again missed out. So that is a phenomena which is very prevalent, and to be honest, it is just not us. It is a very common behavior which happens. You keep hearing all the slogans which say that you need to sell when the markets are at high, buy when it's low. It is all easy to say conceptually, but practically for us, it's very difficult to implement. So today, ideally, if somebody says, I thought high was in March 2020 or 21, and I sold off because I could see 100% returns in most equity funds, or maybe 80 to 100%, depending upon which segment of the market we invested in, we could have missed another 20, 30%, which happened. So it's very, very difficult to do that. So how do we do that? Obviously, that's where asset allocation, asset planners, asset advisors come in a very, very big way. Because at times, standalone, we may not have that kind of maturity to decide what is the best part for it. Just like what we do, we go and try and go to a doctor for consultation, or we go to a gym and we get a trainer appointed for us, a personal trainer appointed for us. What do they do? They only supplement. So the doctor only gives us boosters there, correct? Medicines, which only boosts our own immunity or our own, you could say, the body's ability to counter the disease which you're facing. Similarly, in a gym, we have to do the heavy lifting has to be done by us. The trainer is only going to give us the support and tell us how we can do. So that's where an advisor also comes in. This is just one study which is done by Dalbar, which is a US-based entity, in terms of how this behavioral gap affects. And you could see that red column, which tells you the difference between the returns which an investor got and the returns with the underlying product delivered. You could see the gap being significant. So this is over a longer period of time, a 5-10% compounded return gap tells you that how the experiences are really, really bad. And this also kind of plays in our mind. So once we have this kind of experience where we think the fund has done well, but we're not got, we will actually turn our thoughts away from that particular asset class and possibly miss out. So typically, why does this happen? So there are a lot of times we tend to take things at a discounted kind of this thing. So a lot of times, as we rightly in the current this thing, we tend to underreact today to a lot of new information which keeps coming in. Possibly we could see how large entities. So there are a lot of case studies which keep happening, that people don't believe that the world will change, the way things are done will change. Even though today there are a lot of examples in front of us, we have seen how some of the leading companies across various facets of life have all today non-existent today because they failed to adapt, or they underreacted to the changing information in a very, very significant manner. We could see how some of the large automakers were dismissive about something like Uber coming in or a Lyft in US coming in, and we all know what kind of disruptions they carried out. You know the famous case story of Kodak, a leading business in the camera space. In fact, they actually had a prototype developed, which was picked up by Apple subsequently, in terms of digital cameras and how that revolutionized the entire thing. So there are enough and more examples like this, but typically what happens is we tend to underreact to some of these possibilities, even from a investor's perspective. As I said, today, valuations, if that is the only metric we follow, most of us would think it's too expensive. It's a very simple thing. Why should we invest now? We will wait, let a correction happen, honido, and we will participate at that point of time. But we at times, as I said, underreact to new information. What is the new information today we have? For instance, liquidity. how that has changed the entire name of the game. Looking at various asset classes today in the prevailing circumstances, even a number, say a 23 times forward valuation for Indian equities on a 1 year basis, might have to be looked at in a different way, unlike in the past decade. Because if you just look at history and analyze, it tells you a very simple thing. 17 used to be the average valuations for this country, or 19 used to be the average valuations for this country. Today it's at 23, so naturally very expensive. Stay out. But the fact is, are we looking at the interest rate scenario which is there? Are we looking at the liquidity scenario? Are we looking at the alternative possibilities which people have, which investors have? So looking at all that, you will have very different this thing. So this kind of reaction, either underreaction or overreaction, so both of this will fit into this particular example, uh, is one of the things which impacts our decision making thing. It is not as objective as it should be. So typically, they say a lot of studies have been carried out as to how the investment grid works, like investment decision happens like. So the ideal form is something like this. So base to ensure that long-term wealth creation possibilities are there, long-term possibilities are there, starts with the investor behavior. So that is the most important aspect which needs to be taken into account, which needs to be managed. So that discipline which we talk about is nothing but investment behavior. Because finally, as I said, all of us have our own emotional way of thinking, emotional quotient, EQ, which stands in our way in terms of making unbiased, objective kind of decisions. So once we sort that out, the rest of the things can follow. The next step would be to get the asset allocation in a right manner. Then obviously trying to look at where we should invest, basis taxation, what kind of products should we invest. Say, for example, equities, you might say, where should one should invest today? Is it large cap, mid cap, small cap? In fixed income, you could say long duration, short duration. So all this kind of commodities, which kind of commodities you should invest. So all this would come in. That is all secondary. Whereas if you look at how the investment actually happens, so typically a lot of investments are driven by taxes today. Where do we get benefits from a taxation point of view? We try to go with that. Then we tend to get some tips from our friends who are obviously more visible in a bull market rather than a bear market. And they will tell you that I made so much of money from our neighbors. So fear of missing out, FOMO, as it's called, the neighbor is making money. Let me also try and participate. All this plays a much bigger role. The aspect of allocation of assets, which obviously we would need support from external advisors, like holistic also in this case. And more importantly, try to look at our own behavior in a more objective manner. Are we trying to do the right thing for the current times? These all are crux here. So there is a small case study. Again, some of you would have heard about this. So what are we trying to say? You could see two pictures on your screen of a fairly old lady by the name Grace Bronner, and on a smart, suave kind of gentleman there by the name Richard Fuscon. So this is a very interesting case study, and it's also, which is very relevant for most of us. In fact, it made me at a personal level, when I heard about this story, as to made me think in a very deep manner. Because how are we planning our investments? So what's the story all about? Grace Bronner was actually had a very troubled childhood, and during the time of Great Depression, she got a work as a secretary or a steno in a pharmaceutical company by the name Abbott, which all of us know about, which is present in India as well. She started working there. Her investments were largely into Abbott stocks, but she bought three stocks, which was worth $180 at that point of time, and she held on that over a period of time. What happened was, during this time, that company went through a lot of splits. All the dividends she used to get was getting reinvested in the same stocks. She kept buying more and more, and she just kept holding on. So obviously, the company also went through a lot of cycles of good, bad, and not so great, indifferent kind of periods. They went through a lot of splits, a lot of demergers, which happened. All this happened, and over a period of time, this gave her a fantastic returns of something like compounded returns of about 15% plus. Uh, by the time she lived till 100 years, and the time she passed away, she gave all her wealth to an university which she studied in, and which was worth some $7 million. So that tells you huge amount of wealth creation. People were quite surprised because she led a very simple life, a very small house with, to say, very basic kind of things. Nobody believed that she could have such a chunk of money with her. And where did she make all this money? She didn't have any information on financial markets. She probably never thought about investments as much, except for having these shares and just keeping on reinvesting there. But the only thing is, which stuck very, very well for her over the period of time, was the kind of discipline she followed, irrespective of difficulties, challenges, which obviously would have come to her life as any one of us, where we tend to pull out money from our investments, or we don't stick to our kind of stated goals. She didn't do all that. She just stuck to that one simple philosophy, and that's how she created such a humongous amount of wealth. In fact, they say financial markets is a very strange place because here everybody is equal, unlike a lot of other aspects of life. Say, for example, sports. Possibly, even if we play as good or try to be as good, we probably would not be as good as what a Sachin Tendulkar was in cricket or a Tiger Woods is in golf. Whereas when it comes to financial markets, it's a great leveler. You could see a person like Grace Garner and compare that with Richard Susan, which is who was a very, very big banker, and who created immense wealth. In fact, he was the richy rich of the US, and he actually was chairman, vice chairman of Merrill Lynch, and he made such a big fortune that in his mid 40s he decided to retire and move into more of aspects which he loved doing, which is trying to create or support a lot of the charitable institutions. But what happened was subsequently he went bankrupt. He had to sell off some of his prime properties, which we had. He had a mortgage against all of these. Some of these were 20,000 square feet of house, which he had to sell. He had a huge mortgage of $66,000. He went penniless. He went bankrupt. So what affected each of them was once he retired, his lifestyle changed. He just kept spending all the money which we had inherited at that point of time, obviously through the years of working as one of the premier bankers in the country. But there's lack of discipline at that point of time, probably overconfidence that because he understands the markets well, you'd be able to do and take right decisions at the right time or trying to time. So all this came to a naught. In fact, closer home, I just happened to see one of the WhatsApp videos. I'm sure most of you would have seen it. It was of the legendary cricketer Kapil Dev, and it's a very short video. In case you have not seen, do try and see if you can get to see that. Just about a 1.5 minute kind of video getting interviewed by I think Star Sports anchor there. So he asked him that. Then the question is nothing about sports. He says that very interestingly, I've seen that you have been almost a serial entrepreneur during your life, where you kept investing in a lot of businesses. So how did it start? So here Kapil narrates a very interesting incident, which kind of made him think on that lines, and especially from an investment point of view. So Kapil Dev here highlights that he was talking about one of the test matches they were playing in Bombay. At that time, it used to be called Bombay, 1980s, and India won that match, and all the players were celebrating post-match. So another legendary cricketer, obviously much older, Chandu Borde, was the manager for this particular team. So Kapil just saw him outside and asked him that why you're not joining the celebrations. He said, no, I'm going home to Pune, which is just about a couple of hours drive, and so I will be moving and I'll just join you in time for the next match. So after about a couple of hours, Kapil again saw him still standing there. He said, how come you're still here? You didn't go to your place. He said, no, I'm just waiting for the board secretary. He's sleeping right now. He's still not got up because I have not got my daily allowance. So Kapil Dev points out to this and says, this is a legendary cricketer who's played for several years for India with a lot of distinction. Today, as he has to wait for the board secretary to give him his daily allowance so that he can go to his place. So that made me think quite a bit that cricket life is much bigger than cricket. and how do I intend to manage this lifestyle even post my playing days. That is very, very crucial, and which is how this whole spirit of entrepreneurial spirit, or trying to invest, or being associated with a lot of businesses started in mind. And from since then, I've been regularly trying to ensure that my investments are optimal. So we have more and more examples. So Michael Jackson, obviously, most of us know this case study again, that how this man whom the entire world used to cherish uh, ended up in a poverty-like situation. By the time he died, he ended up with a lot of debt. In fact, that's what he left his near and dear one with. A very recent example, a couple of weeks back, you would have heard of this cricketer from New Zealand who was quite popular in India, called Chris Taines. How one of the leading all-rounders of his time today has really suffered. In fact, I think he was working as, I'm not too sure, some garage. I'm not too sure, or maybe some salesman in the recent past. Given the fact that he had dipped quite significantly in terms of his investments, were today completely gone, and very difficult for him to sustain his lifestyle. So what it tells us is it's very, very difficult to try and time the markets. A lot of times, this slide is what it tells in a very simple way. Investments is boring because we need to give time in the markets. We should not get swayed uh, by what's happening, because all this are distractions, and that can have very, very big impact. So this example of growth I mentioned earlier, growth fund, we can see a lot of market events being plotted here, only the negative events, because that's where you tend to get worried. In fact, today, if I want to add one more thing, we could say valuations. Uh, they are our biggest fear. Despite all that, we could see the growth of the NAV, growth of the fund happening. This could be true for any other fund, to be honest with you, and especially over a longer period of time. Actually, this is what I mentioned at the beginning of the call also. Over a period of time, if you're disciplined, the risk of a particular asset class actually tapers off. So here I have taken equity as an example because we have very long history. Also because a lot of us tend to follow this particular asset class because, as I said, there's always this uh, thing attached to the equity markets where you could actually be very flashy in terms of the return possibilities. You can sound very intelligent by saying that I made 100% in just 1 year, 6 months. Uh, but obviously things, when they go bad, nobody talks about it. But from a longer period of time, so we did a very simple analysis. What we see here is a very simple analysis, and we took one simple data point of BSE Sensex, which has got a very, very long history now, 40 years, 41 years to be precise. What we did was we calculated a rolling returns for this, and we looked at various time frames. So typically, if you look at 5 years and beyond, so what is highlighted in red is you end up with negative returns, and rest of the periods you would have ended up with positive returns. So during this 40 years, somebody entered at any point of time, stayed invested for at least 5 years. What would have they got from the markets? Only 8% of times out of this 5 year period, somebody would have seen a negative return, which goes down to 1% over a 10-year time period. And you could see the average returns over a 10-year time period would have been roughly about 15%, on a 5 year also 15%, which tells you the immense possibilities of the asset class. It also tells you why discipline is very, very important when it comes to goals. Uh, SIPs, I mentioned to you, it's unfortunate that we could see people stopping it when things were bad for the markets, and again restarting possibly now. All this keeps happening. So one simple example to highlight the power of that. Say, for example, one person started investing 10,000 rupees over a period of, say, from 25, he started investing, and he felt that this needs to be just set aside as a retirement saving vehicle. So even at a 12% kind of growth, which is quite possible, and we are not taking any exorbitant number here, you could see that is 10,000 per month over a span of 35 years, which is roughly about 40 odd lakhs of investment, grew to about 6.5 crores. Same thing, a friend of his also started by looking at him that let me also try and be there in the markets. But unlike Jay, Viru was having a lot of challenges in managing his emotional quotient. And every time difficult period used to happen in terms of personal finances, which used to happen for Jay as well. But because he was clear and he set aside that money, he never touched it. Whereas with Viru, he used to take advice from people, his own friends, and then they used to say that now probably you should book profits, you should come back later. So he did all that. He kept on withdrawing money at various junctures. And what we could see is that over this period of time, he almost withdraw equal to what he invested. And finally was left with not even 15-20% of what his friend earned over this period of time. So the same amount of investments would have fetched him only 87 lakhs because he withdrew almost equal an amount of the investment which he made, which is 40 lakhs at various points of time. So not done on a regular basis, but sometime in a 1 year, sometime in a 2 year, we could see some kind of withdrawals happening. So this is a very stark example. We might even look at this as just numbers. But to be honest with you, this case study is not just a flimsy one. The time period obviously is a little longer here, but with my own personal experience and talking to a lot of friends, I've seen this happening to a lot of us at various points of time, and this is trust me, some of you might even be able to relate to this as to how this actually erodes the wealth creation possibilities from a longer term perspective. This is just a small chart. I'm not again trying to promote anything here, just to show you that what is the possibility of wealth creation through SIPs or through lump sum, especially if you hold it from a longer term perspective. So what is interesting about this, there are a lot of data points, is one simple aspect which I want to try and highlight to you, is the fact that if you look at the since inception kind of returns for most of these products, and you can see very different kind of products, and especially for those set of products which have a slightly longer history, what we could see very clearly is that over this period of time, uh, despite ups and downs, some of them are themes. For example, power kind of theme or infra kind of space went through a big challenge in India. Despite that, they would have still seen double-digit kind of returns happening there over a period of 10, 12 years. So this has been a phenomenal kind of thing that if you're disciplined, the possibilities of wealth creation go up significantly. So that is something which we need to bear in mind. So what is this picture all about? Uh, can you just guess? It's obviously an office of a particular person, but if you look at this more in detail, what it tells you, it's a very modest kind of office. And can you believe that it is the desk of Warren Buffett, one of the richest when it comes to world, in fact, one of the most well-regarded investors of all time, and who made all his wealth by investments and choosing the right investments and holding it for a period of time, but very frugal when it comes to very frugal when it comes to the spending part. In fact, you could see that how the power of spending, what he did was a good part of power of innovation. Sorry, how it happened. In fact, a lot of his wealth was made after he actually turned 60, 50. So that tells you that how this long-term kind of no computers on a table. I think somebody has committed. We don't know. Possibly he might be using a laptop. But what it tells you is typically that investments is boring. Investments is not flashy. Something which you will have to stay from a longer period of time. So this is something which I thought could be interesting. So finally, asset allocation is the crux when it comes to long-term wealth creation. So that is how it can make a big difference. For example, we have seen that typically with various studies across the world, 90% of time wealth creation is attributed to getting your asset allocation right, and that involves a lot of decision making when it comes to especially in things when things are very troubled, and that's a time we need to ensure that our discipline doesn't break, our asset allocation goals we need to stick to, and that actually can make a very big difference when it comes to our long-term wealth creation possibilities. I think I've taken quite a bit of your time. Let me stop here.